When you get started in the stock market, you hear this term called diversification get thrown around a lot, which is basically the process of making your portfolio safer. Wouldn't every investor want to make their portfolios safer? Isn't this the obvious choice? Not really. Most of the best investors in history don't believe in diversification, and maybe you shouldn't either. This concept could be the difference between losing everything and beating the index long term. So in this video, I will be going over the pros and the cons of diversification and seeing if it's right for you.
Is it right? Yes.
Hi, I'm Giannino. I teach you how to make money, grow money, and invest money. So please like this video and subscribe to the channel. I would greatly appreciate it. Again, going over it in depth some more, diversification is the process of adding more unique investments to your portfolio so you're not overly invested in one stock or one sector. This process adds overall safety to your portfolio so you don't have to subject yourself to huge overall portfolio losses. Why will this save you? Why do you need it? Number one, it will help you avoid the worst cardinal sin you can make in investing. This sin can cost you every penny, every dollar you ever put in the stock market. This huge mistake was made by an investor I talk to regularly. This investor is in some desperate need of diversification, and let me tell you why, because most of you are making the same exact mistake as this investor. This investor approached me telling me a stock was going to pop 50 to 100% in the next couple weeks because news was coming out and it was looking bullish. 100% convinced this stock was going to pop, the investor threw money into it and thought it was going to hit this exact price level. They said, I am selling here, I'm not selling anywhere else. And the stock did pop. It did make the investor tons of money. I texted the investor and asked them if they sold yet. The investor said, no, I didn't sell. I'm hoping for it to hit this price level now. So now the greediness is in. The investor did not sell when they were going to sell, and they are holding into a stock that was a day trade or swing trade. Now it's a long-term investment, so they're confusing what they thought it was, which is one thing I talked about in one video. Know why you're investing, know why you're holding the stock, and most importantly, don't change your mind later. But this investor was making tons of money. I could see the greed coming out of their eyes, and what happens next will shock you. This stock made a short squeeze that same day we were talking. It went down tremendous amounts. If you don't know anything about the stock market, a short squeeze is the worst thing that can happen from a trend. It is the exact moment the stock market has topped and the reversal has begun, meaning the stock market is not going to make new highs like this investor thought it was. I sent a quick text to this investor letting them know it was a short squeeze. This stock is most likely not going to make new highs for a long time, and their response makes me cringe. I can still feel the pain of reading the words in this text message. This is a mistake every investor, even you, are gonna make in the stock market. They tell me, I don't care if it was a short squeeze, I believe in it long term. Whoa, this was a day trade. Now it's a long-term investment. This is a big mistake. But let me get into where diversification comes into effect. Instead of just holding the stock, looking at other opportunities, the investor continually bought this stock as it was dropping. So their portfolio is 100% one stock that is completely risky. Two huge mistakes you can learn from this investor. Number one, don't confuse a day trade or swing trade with a long-term investment. And number two, if that investment goes down, do not add to it, because then you will not be diversified and you will have too much money in one thing, which is always a bad thing to do. And the last mistake, number three, this investor made was they became stubborn on their investment. They were blinded to anything that came out that was bad and only saw the good news. When that happens, you know you are bound for failure and bound to have huge losses in your portfolio. Never be a stubborn investor, seriously. This story is meant to shock you. It also is meant to show you the power of diversification and why it's important, because that one investor's portfolio is solely contingent on the success of that one stock. But now let's go into diversification in depth and talk about Who needs it? What type of person needs to look to diversify their portfolio? Of course, it's my investor that I was talking about earlier, but also people that are not professional investors. They should be looking to diversify because unfortunately they're not smart enough to pick a couple stocks and have those do well long term. It's just very hard to do. People that need to diversify are those who cannot read financial statements, listen to earnings calls, understand the company metrics, understand the numbers within the company too. Lastly, those who need to diversify are those who are investing in risky stocks. So if you're investing in IPOs, the chance of an IPO doing well long term is very slim, let's say 10%, meaning 1 in every 10 IPOs will succeed in 10 years. So what does that mean? You should probably hold 10 IPOs so you can have that one winner. If you hold 1 IPO or 2 IPOs, the chance of you having success long term is very slim. If you're investing in penny stocks, you should be holding at least 5 to 30 of those because those are ultra high risk with a super low chance of being here even 5 years from now. If you fit into any of those categories, you need some diversification in your portfolio, and I'm going to teach you 3 easy ways to diversify your portfolio. With step number 1 is only put 1 to 10% of all the money in your portfolio in one stock. If you have 50% of your money in one stock or 70% in one stock, you are overweight. That stock in your portfolio has too much risk, and the best way to avoid that is to stick to that 1 to 10% rule. The next way to diversify your portfolio is look to have a maximum of 25% of your money in any one sector. So this could be oil, this could be electricity, this could be retail, this could be commodity products, this could be airlines. If you own 50% of your money in airline stocks and 50% of your money in tech stocks, you are only betting on the airlines or the tech sector to do well for the next 20 to 30 years. That just might not happen. That's why it's important to have 25% maximum in any one sector. And the third way to diversify your portfolio is check out bonds. Most people have a ratio of bonds in their portfolio based off their age. So if you're 20 years old, you should invest 20% of your money into bonds. 30 years old, 30% into bonds, and so on and so on. The reason for this is because bonds pay a certain yield every year that you can expect, basically risk-free. So even if the stock market does not do well, you are diversified in another type of investment. But I just want to make it known I'm not a financial advisor. This isn't financial advice, just trying to provide you with education. And guess what? There is a downside to diversification. There is a reason the best investors in the world do not diversify. And that's what I'm going to talk about right now. Number 1, the main reason the best investors do not diversify is because they water down their returns in the market. So when you hold 5 stocks, it's much easier to beat the overall index, which is 7% per year with 5 stocks. But if you hold 100 stocks, at that point you're just mimicking the index, and the overall returns of those 100 stocks will not be that high because you are too diversified. Just for example, Warren Buffett, the best investor in history, owns 17 stocks. The index fund for the SPY holds over 300 stocks. So when you hold a core group of stocks that you know will do well after doing your research, you can beat the overall returns of the market because the market has a lot of stocks, and if some sectors do bad, some sectors do good, it all averages out. And this is one huge way to beat the returns of the stock market. Get 15-30% per year. I talk about this in my trading and stock market course below. Make sure you check that out. It has all the information I've ever learned about the stock market in there. Now let's talk about the type of person that doesn't need to diversify. And this person is someone who will do the research, who will look through company financials, who will listen to the earnings calls to know how safe their investment is, who can read the metrics on certain companies. This person, like Warren Buffett and Ray Dalio, they will outperform the market in the long term because of this knowledge and because they are not diversifying. So going back to it, the major advantage of not diversifying is getting greater returns in the market. You can buy many risky IPOs that will return 100% in a year or 300% in a year. And the stock market on average returns 7%. So if you pick the right stock, you can greatly beat the returns of the overall market. But you're also subjected to huge losses if you're wrong and if your research was not correct. But seriously, it's not easy to be a stock picker, and if you want to get into the market and invest risk-free, you should check out index funds. These are great investments, and I made a video to the right I think you're gonna love. And last time I checked, Warren Buffett doesn't own any index funds out there, so is it really the best investment you can make? In this video, I'm going to give you the pros and the cons of putting your money in the index fund.